I'm Karunya Rao, and in Ideas for Profit, today we talk about tyre manufacturers. CEAT, Apollo Tyres and MRF are seeing a stellar ride on the back of a sharp pickup in demand from OEMs and replacement segment. Q4 numbers corroborate the strong pickup in demand. All the three companies have posted a robust top-line growth. However, the benefit of operating leverage is being washed away by significant rise in raw material prices. So then what makes us upbeat about these companies? Demand situation, especially in the two-wheeler and passenger car segments, is expected to be very robust as people would avoid taking public transport and will prefer using private vehicles. This strong demand has benefited tyre manufacturers. With receding impact of the second wave of the pandemic and spread of vaccine coverage, long-term outlook is positive. Meanwhile, the farm equipment segment continued to do well as most of the segment's demand comes from rural areas, which is least affected by the first wave of the pandemic. As a result, demand pickup has been sharp after lockdown restrictions were eased. Going forward, higher crop production, good crop prices, sufficient availability of water, and easy financing options are expected to augur well for the rural economy. Concerns regarding demand pickup in the CV segment are also abating. CV numbers are expected to improve as the economy starts picking up. Tyre companies remained resilient during the pandemic due to strong replacement demand. The demand witnessed a significant fall in the months of April and May, though, because of the second wave of COVID-19. However, CEAT management has highlighted that replacement demand has started picking up in the month of June, post the decrease in the number of fresh COVID cases. They also highlighted that CV segment is the most promising, it's the most buoyant, and they expect truck and bus radial segment to witness the sharpest rebound within the replacement basket. Meanwhile, if you talk about raw material costs, the prices of natural rubber and crude oil, the two most important raw materials for tyre companies, both of them continue to move upward, which is expected to have a negative impact on the operating profitability going forward. The RM basket witnessed a sequential rise of 8 to 10% during Q4 FY21. It's expected to rise further by 10% sequentially in Q1 FY22. Though the companies are taking price hikes to mitigate the impact, there is limited scope in the short term as the demand is still subdued. Let's look at the Q4 performance then. Apollo Tyres posted a strong set of numbers. It saw a 39% year-on-year growth in net sales, led by a 49% YOY growth in revenues coming from Asia Pacific, Middle East and Africa regions. A significant operating leverage helped the company post a margin expansion of 290 basis points year-on-year. To mitigate the impact of raw material prices, Apollo took a 4.5% price hike during second half FY21. In fact, the management highlighted it's planning to take further price hikes both in India and European markets. The company has gained across segments in FY21 compared to FY20. It gained 400 bips both in passenger car radial and agri segments, 100 bips in TBR segment. The rise in share was fueled by aggressive network expansion, efficient supply chain management, and an increase in demand. In the international market, management indicated that demand is showing signs of recovery there as well. Meanwhile, if you look at CEAT, it registered a YOY growth of 45.5% in revenue, higher than its peers, driven by a 45% volume growth across segments. It also gained 4 to 5% market share in the PV segment. Higher raw material prices and adverse product mix led a margin contraction of 135 basis points year-on-year. Management expects demand to pick up post-lifting of lockdowns, like I said. They also highlighted that demand for PV and TBR segments is expected to be very strong, whereas for two-wheelers, it could be challenging. To mitigate impact of RM prices, the company has taken cumulative price hike of 4% in April and May 21 and may take one more round of price hike in the month of June. MRF, the market leader among tyre makers, recorded a year-on-year revenue growth of 31%. Its EBITDA margins remained flat for the quarter due to significant rise in raw material costs at the current market price. If you look at all three stocks, the valuations of the companies look extremely attractive given the demand outlook. Therefore, we advise investors to keep accumulating these companies with an eye on the long term. Of course, key risks to watch out for will be any slowdown in demand that could hurt financials. Moreover, adverse movement in commodity costs will increase raw material costs for the company and hurt operating profitability. So therefore, important to watch out for these key risks as well.